Okay, today we're going to move on to 12.2, which is determining payroll tax withholding. The first learning objective that you have today is to be able to demonstrate the process for determining federal income tax withholdings. The second one that you'll have today is to be able to demonstrate the process for calculating Social Security and Medicare taxes. So those are the three different types that we're going to be calculating today. And then the third one is to be able to explain the benefit of funding medical and retirement plans with pre-tax contributions. So payroll taxes. Taxes based on the payroll of a business are called payroll taxes. Payroll taxes, just like sales tax, represent a liability to the business until it is made to the government. Until we make that payment to the government, it's a liability because we're taking it from the employee's paycheck and then putting it in an account to save for paying the government later. So it's a liability until we pay them. Any amount withheld from an employee's gross earnings is called a payroll deduction. We're just deducting that amount from their paycheck. A deduction from total earnings for each person legally supported by a taxpayer, including the employee, is called a withholding allowance. So employers are required to have a current Form W-4 on file for all employees. So all of you that have ever had a job most likely have filled out this W-4 or should have, because that's the file that they need on hand to hire someone for taxes. So a Form W-4 is filled out by the employee when hired. So you fill that out as an employee when you get hired for a job. The amount of income tax that will be withheld is based on your marital status and also the number of withholding allowances. So an example of a withholding allowance would be like a child that you have. So a married employee will have less income tax withheld than a single employee. The larger the number of withholding allowances claimed, the smaller the amount of income tax withheld. Okay, so the more withholdings you have, the less you're going to have taken out in income tax. An exception from withholding is available for certain low-income and part-time employees. And we'll get into that later, not so much today. So this is what a W-4 looks like. Again, if you've had a job, you've probably filled one of these out or should have. But the first thing they need is the name and address. They need your Social Security number, because that's how taxes and stuff are filed that way. Your marital status, you have single, married, and then also you have married but withhold at a higher single rate. And then you have your withholding allowances, and there's a separate area that you can figure out your withholdings, and then you bring that number total back here. And then they need your signature and date on file. So this is a chart for a single person's payroll period. So this one says semi-monthly, and that's what we're going to work with right now. So we're calculating things, and I'll show you how to do that with this, but this is a single person's, and then this one is a married person's. Okay, so you have to make sure you have the right chart to work with, and these are in your book, or they're on you can pull these slides up. I'll post it in Classroom. So you have to select the appropriate table, married or single, locate the employee's total earnings. So it always says at least $1,460, but less than $1,480. So that's where we're going to look at right now. And then you have to locate the number of withholdings or withholding allowances. So this person has 4. So they made $1,460 for withholding allowances. Then we cross them, intersect them, and we get the amount that's going to be taken out in income tax. So again, reading it closer, let's see an example here. What is the tax on $1,080 for a married person with 3 withholding allowances? So I'm going to first find $1,080, so at least $1,080, okay? For a married person, I'm in the married person's chart with 3 withholdings. So $1,080, 3 withholdings, I'm going to have $37. That's how much is going to be withheld. So you need this chart in order to figure it out. So make sure you have this handy. Okay, so now we're going to move on to the Social Security and Medicare tax. A federal tax paid for old age, survivors, and disability insurance is called Social Security tax. A federal tax paid for hospital insurance is called Medicare tax. So then you have your total gross earnings year to date for an employee is called your accumulated earnings. So as you're going through the year, you start in January or whenever you're in pay period here, we start in January, and then say we're in March, we have our pay period earnings, but we also have the accumulated. So for the year so far, up to date, this is what it's called, your accumulated earnings. The maximum amount of earnings on which a tax is calculated is called a tax base. So Social Security and Medicare taxes are paid by both the employers and the employee, okay? Employers are required to withhold and deposit the employee's part of the taxes. So we withhold that before we give them the paycheck so that we can deposit it. This is our liability that we will pay later. And we will pay a matching amount of these taxes. So whatever the employee is putting in, we match. And some businesses have a set amount that they'll match up to an area or a percentage of income. And then there's that max or tax base there. Social Security tax is calculated on an employee's earnings up to a maximum paid in a calendar year. We won't have to deal with this as much today. The maximum amount of earnings on which a tax is calculated is called tax base again. So the Social Security tax rate is 6.2% of earnings up to a maximum of $132,900 as of 2019. But note that at the time the book was published, the tax base was $106,800. Okay, so that might change a little bit. Again, we won't have to deal with this today, but when we come up to it, I will make sure you understand this part. So the Medicare tax rate is 1.45%. These two percentages are something you have to know in order to calculate these things. Okay, so make sure you have those two tax rates written down because we will use them very often. And then there is no tax-based limit for Medicare tax. Now we move on to the voluntary deduction. So these aren't things that you have to have deducted from your paycheck, but they are things that you can voluntarily do, but it's pre-tax money. Okay, so a retirement savings plan approved by the Internal Revenue Service, or IRS, that provides individuals with a tax benefit is called a qualified retirement plan. A 401k is a qualified retirement plan sponsored by an employer. So it would be if your employer offers it, but you get to decide how much you want to have deducted to be put into that. An individual retirement account, or an IRA, is a qualified retirement plan that provides most individuals with a deferred federal income tax benefit. And then you have a Roth individual retirement account. Is a qualified retirement plan that allows tax-free withdrawals from the account. So a Roth IRA and an IRA, there's some differences. Again, we'll get into this a little bit more later, but just so we know that there are these that are qualified retirement plans, and then there's some differences between the two. Okay, and then we'll end this one and we'll pull up the work together and work through that one.